Welcome to The Deep Dive, your go-to for cutting through the noise of earnings calls and getting right to the core insights that matter to you. Today, we're doing our Talk Ticker segment, taking a dedicated deep dive into the Q2 2025 earnings call of a major European financial institution. Now, on the surface, it looked like a quarter with some, strong beats, some significant strategic shifts. But as we pull back the layers, a more nuanced and maybe strategically vital story about this institution's future starts to emerge. And that really helps explain the market's kind of reserved initial reaction, wouldn't you say? So let's kick off with the headline numbers for Q2. This company actually delivered a solid beat on earnings per share. They hit 0.56, which was about $0.04 above what analysts expected. And that's reported under IFRS EU, the International Financial Reporting Standards, common in Europe for those of you keeping track at home. Net profit also looked really strong. It soared to $1.675 billion.
Yeah, that was a solid beat, surpassing consensus by about $0.11 billion. Pretty good.
Right. And total income, which we often look at as a key proxy for overall revenue, came in at $5.70 billion. That figure remained stable year over year and, well, essentially met market expectations. So no big surprise there. But digging into the core components, fee and commission income was a real bright spot.
Definitely a highlight.
Yeah, seeing significant growth, up a healthy 12% year over year to $1.12 billion. Now, on the other side of the ledger, commercial net interest income, or NII, the profit from core lending minus deposit payouts.
The traditional banking stuff.
Exactly. That was down 3.7% year over year at $3.77 billion. So a bit of a divergence there. Capital strength looked robust, too. They reported a CET1 ratio of 13.3%. And for those unfamiliar, CET1, Common Equity Tier 1, it's a critical measure of a bank's core equity resilience, its ability to absorb losses.
Super important metric, yeah. 13.3 is quite solid.
And their quarterly return on equity, ROE, also IFRS EU, stood at 13.9%. The balance sheet showed strong underlying growth as well. Net core lending increased by $15.4 billion.
Which is quite a jump.
And net core deposits grew by $6.2 billion. And finally, they announced an interim dividend of $0.35 per share alongside a continuing $2.0 billion share buyback program.
So returning capital, which shareholders always like to see, what's truly revealing here isn't just the strong headline beats across profit and capital metrics, it's the powerful story underneath them. You've got this clear divergence in income streams.
Exactly, that fee versus NII split.
Precisely. The robust fee growth isn't just a good number. It's like tangible proof of a strategic pivot. And it's one that, frankly, few banks are executing with this kind of agility. The NII softness, while, immediately concerning to the market and prompting that cautious initial response you mentioned, it might actually be masking a more resilient, more diversified future for this institution.
Interesting take.
Yeah, potentially setting it apart from peers still heavily reliant on just traditional lending. That's the real nugget here for anyone trying to understand their long-term trajectory, I think.
That's a great point. So let's pivot from the immediate financial snapshot to the strategic engine driving these numbers. This institution is clearly executing a compelling dual strategy. What are those main priorities and how are they fundamentally reshaping the business model to achieve that more resilient future you just mentioned?
Exactly. The strategic focus is decidedly two-pronged. First, they are intensely focused on enhancing capital returns to shareholders. We see that directly reflected in that ongoing $2.0 billion share buyback and the announced interim dividend. That's a clear commitment, right?
Very clear signal.
Second, and equally important, is this deliberate drive to diversify income streams, shifting towards a more fee-intensive mix. We see this playing out. Fees now constitute almost 20% of their total income. That's a significant chunk.
Almost a fifth, yeah.
And this shift is intentional. It's underpinned by a disciplined change in capital allocation. For example, the share of capital dedicated to retail banking already exceeds 53%, and they're actively moving towards a target of 55% retail and 45% wholesale by the end of 2027.
So leaning into retail.
Right. And this move is strategic because retail banking, despite often having, lower lending margins, it offers a higher return on equity. Why? Because it has lower risk-weighted asset consumption.
Yeah.
Essentially, they get more bang for their buck, capital-wise.
That's fascinating. So essentially, they're kind of trading raw lending margin for significantly better capital efficiency and ultimately higher return on equity. That's a classic strategic realignment, but one that, it demands precise execution to truly pay off, wouldn't you say?
Absolutely. Execution is everything here.
And speaking of that fee growth, which is impressive, you use the word pivot, which suggests something really deliberate. Is management's confidence in this trajectory backed by distinct scalable initiatives, or are we seeing more cyclical tailwinds, maybe? What are the key drivers you're seeing for this structural growth that truly differentiates them?
You've hit on a critical point about execution. Management certainly expressed increased confidence in their trajectory. They're now expecting fee income to grow at the upper end of its 5–10% range for the full year.
The upper end, okay.
Yeah, with an ambitious target of $5 billion by 2027. This structural growth, or alpha as they kind of see it, really is coming from several distinct and scalable areas. Firstly, a continuing increase in mobile primary customers, those who use them for their main banking needs.
Ah, the sticky customers.
Exactly. That's leading to higher daily banking fees. It shows digital engagement translating directly into revenue. Secondly, they're seeing strong performance in investment products, driven by both an increase in the number of accounts and more active trading.
So people are using them for more than just current accounts.
Right. People are clearly trusting them with more of their investment portfolios. Yeah. And thirdly, there's what they describe as a snowball effect from insurance products, which contributed almost $70 million in fees this quarter and are steadily expanding their reach.
A snowball effect. I like that.
Yeah, it suggests a powerful cross-selling capability as they deepen those customer relationships.
That snowball effect from insurance is a great visual for how that growth can compound, yeah. But while fees are looking up, net interest income, NII, was clearly a headwind this quarter. How much of a drag was that really, and what's the outlook there given the current macro environment?
Commercial NII indeed faced some headwinds. We saw a sequential negative impact of $37 million, primarily due to the euro's appreciation against the US dollar in Q2, which obviously affects their international operations.
Right, the FX translation.
And I was also affected by the lower ECB deposit facility rate, which impacts how much they earn on deposits held with the central bank. Looking ahead, management expects NII to stabilize in Q3. The full impact of that Q2 foreign exchange headwind will likely be felt then, before they anticipate NII to start rising in Q4 compared to the first half of the year.
Okay, so some stabilization then, an uptick expected later.
That's the projection. This projected recovery is driven by volume growth and an expected moderation in that FX impact. For 2026, they anticipate a recovery in lending margins, moving from around 125 basis points in 2025.
So 1.25%.
Right, to 130 basis points, so 1.25% to 1.30%. This will be fueled by higher margin business banking and consumer lending. That's where the retail shift helps again. They also project additional income from savings repricing and term deposits to offset a $300 million reduction in replicated income. The long-term liability margin is guided at around 110 basis points, balancing market competition with their volume ambitions. It's a balancing act.
It sounds like they're navigating some, tough cross currents there, strategically shifting their portfolio to manage those pressures. On the expense side then, how is the company balancing necessary investments in growth and technology with the need for cost discipline, especially in, an inflationary environment?
That's the challenge every major financial institution is facing, isn't it? And they seem to be managing it pretty well, actually. Operating expenses, if you exclude regulatory costs, rose 4.5% year on year. That's due to wage inflation and continued investments in business growth, customer acquisition, technology, the usual suspects.
Right, the cost of doing business.
But it's notable that these costs were stable quarter on quarter, which suggests that ongoing operating efficiencies are starting to kick in and offset some of those inflationary pressures.
So the investments are starting to maybe pay off on the efficiency side.
Seems like it. They're making significant tech investments, like deploying this one app strategy across 6 retail markets, aiming for a unified, seamless customer experience. They're also introducing generative AI-powered chatbots in key European markets. Netherlands, Germany, Belgium, Romania, Spain.
Jumping on the AI train.
Definitely. This focus on efficiency and digital transformation has actually improved their 2025 outlook. Total expenses are now expected at the lower end of the 12.7 billion euro pitch.
So they're tightening the belt a bit better than expected?
Exactly. And it's also important to note Q2 included an $85 million incidental expense for a workforce rebalancing in wholesale banking. That led to about 230 redundancies.
Okay.
Sounds significant, but it's expected to generate an annualized benefit of $40 million from 2026. So again, indicating a long-term strategic move towards efficiency.
So it's not just about, slashing costs randomly, but optimizing and strategically investing for future returns. Makes sense. Beyond the numbers and these operational efficiencies, what innovative products and maybe market expansions were specifically highlighted, things to drive future growth and customer stickiness?
Yeah, a number of interesting initiatives were discussed, which I think really showcase their forward-thinking approach. Take the Netherlands, for instance. Mortgage pricing is now innovatively linked to energy labels.
Oh, that's a clever, linking finance to sustainability.
It really is. It's not just about sustainability. It's a smart strategic move, potentially attracting environmentally conscious customers while also maybe mitigating long-term credit risk related to property values.
Good point.
They're also scaling advanced anti-fraud features like Check the Call and Fraud Case Tracker across markets, directly addressing a critical customer pain point and building trust in their digital ecosystem. That's crucial for their retail growth strategy.
Absolutely. Trust is key in digital banking.
And to capture younger segments, they've launched a Start digital bank account in Spain, specifically for 14, 17-year-olds.
Getting them early.
Exactly. And a dedicated Gen Z investment fund in Turkey. Shows an understanding of different market needs, different demographics. They're also expanding digital business banking, targeting self-employed and SME segments, particularly in Germany. By directly approaching customers after strategically ending a previous partnership, this direct approach allows them greater control and potentially better margins.
Those are some very interesting plays for future customer engagement, definitely. Before we kind of wrap up the numbers part, let's quickly touch on a critical area for any bank. The health of its loan book and its capital buffers. What's the latest picture there? Any red flags?
Actually, no, the loan book quality remains remarkably strong, which is quite reassuring given, global economic uncertainties. Total risk costs were $299 million, or just 17 basis points of average customer lending, which is actually below their through-the-cycle average. Indicates a well-managed risk profile.
Lower than average. That's good to hear.
Yeah. Net additions to Stage 3 provisions, those are the more problematic loans, were primarily from collective provisioning in retail. It's more of a general buffer. While individual Stage 3 costs, which are typically for specific problem loans, actually decreased.
So more proactive provisioning rather than reacting to specific defaults.
Suggests exactly that. A proactive portfolio-level approach to risk. Their CET1 ratio stood firmly at 13.3%, as you mentioned, and the bank's resilience was further confirmed by the latest EBA stress test.
Ah, yes, the European Banking Authority tests. Always rigorous.
Very. And this one projected an adverse, fully loaded CET1 ratio of approximately 10.4% by 2027, even under severe economic scenarios. This is well above minimum requirements, and, well, it speaks volumes about their capital strength and ability to withstand shocks.
Okay, so putting it all together, what does this all mean for you, the listener, trying to gauge this institution's trajectory? Despite delivering what looks like a clean beat on earnings and having a confident outlook on fees and costs, the market's immediate reaction was, well, fairly muted. The stock closed down around 0.34% on the day, though trading volume was above average. What's driving this cautious market sentiment, do you think?
I think this cautiously bullish sentiment, or maybe just cautious sentiment, suggests that while the strong underlying performance, particularly in fee income and cost control, while that's undoubtedly positive, investors are clearly weighing it against these near-term macro headwinds that are impacting traditional banking income.
The NII pressures we talked about.
Exactly. The appreciation of the euro, with that estimated 150 million drag on full-year NII, and the ongoing ECB easing policies, which compress lending margins. Those are the key concerns, tempering enthusiasm right now. It's a classic case, really, of short-term macro noise potentially overshadowing long-term strategic strength.
That makes sense. So with those cross currents in mind, what should we be watching for as key catalysts moving forward? What indicators will signal whether the market starts to truly appreciate their strategic pivot, maybe look past the NII dip?
Several key catalysts are definitely on the horizon. The continued execution of that 2.0 billion share buyback program will be important. It's a direct signal of capital return to shareholders, shows confidence.
Actions speak louder than words there.
For sure. We should also be keenly watching the Q3 results release on October 30th. Need to gauge that fee momentum, is that snowball truly growing? And critically, to see if the anticipated Q4 NII uptick actually materializes. That's a big test for management credibility.
Right, hitting those NII recovery forecasts.
Yeah. Further progress on their strategic capital allocation and those retail cross-sell initiatives will also be crucial indicators of their long-term shift. The company's stated goal of achieving mid-teen ROE outcomes, even amidst rate normalization and currency fluctuations, that'll remain a central theme. And a new development they confirmed. They are embarking on their first significant risk transfer, or SRT, transaction in the second half of this year.
Ah, an SRT. Explain that quickly.
Sure. An SRT is basically a sophisticated way for banks to offload some credit risk from their loan book to investors. It helps optimize their capital requirements, frees up capital. They plan more for 2026. So this could further enhance capital efficiency down the line.
Okay, this brings us to an important point. For those of you maybe with a higher risk appetite, looking for something beyond the standard analysis, we have a provocative idea. Our "This is not financial advice" segment. Given the market's current fixation on these arguably transient NII headwinds from FX and ECB cuts, we see a potential opportunity for a long-term play here. The company's confident guidance on fee growth, particularly from its snowballing insurance products and those growing mobile primary customers, alongside a low-end cost forecast, well, it points to structural profitability improvement that the market might be significantly underpricing right now.
Exactly. So the outrageous but plausible trade idea we're pitching is a long-term, out-of-the-money call option spread on INGA, coupled with a short-duration euro-denominated bond ETF.
Okay, let's break that down. Quite a mouthful.
It is, but let's unpack it. First, the INGAS call spread. INGAS is just the ticker for this institution on the Amsterdam Stock Exchange. This part of the trade is basically a bet that the market will eventually recognize the company's underlying strengths, fee diversification, cost efficiencies, strategic capital allocation, all of which should drive a higher share price over time.
So you're betting on the market catching up to the strategy.
Precisely. A call option spread involves buying one call option and selling another one at a higher strike price. This limits your upfront costs compared to just buying a call, and it leverages a significant upward move beyond the current NII-induced skepticism. The snowball effect of insurance, digital customer growth, buybacks, these things should compound over time. We target options expiring maybe 12, 18 months out. Give it time for these structural improvements to really show up in the numbers and for NII headwinds to maybe ease off or just become better understood.
Okay, so that's the long equity part. What about the other leg, the short bond ETF?
Right. The short duration Euro bond ETF. This acts as your FX and NII hedge, and potentially maybe even a profit center itself. A short-duration bond ETF invests in bonds with shorter maturities, making them less sensitive to big interest rate swings, but still responsive to near-term changes. If the euro continues its strength against the dollar, or if the ECB cuts rates further than anticipated, well, short-duration euro bonds could see some pressure as yields adjust or as investors look elsewhere for better returns. Shorting it benefits from that.
So you're hedging or even profiting from the exact things causing the NII drag.
That's the idea. It's a way to capitalize on or mitigate the very macro trends causing the current NII drag concern. The thinking is, if NII remains under pressure, it's likely due to these very factors, strong euro ECB cuts, which would then benefit your short bond position.
Okay, so the core thesis here is basically that the market is getting hung up on short-term, transient macro headwinds and underpricing the long-term structural improvements the bank is making. This dual strategy aims to capture the eventual re-rating of the company as a more diversified, capital-efficient, fee-driven bank, while simultaneously hedging against those immediate macro cross-currents that are clouding the picture right now. It's definitely a high-conviction strategic play. Not for the faint of heart, maybe.
Definitely requires conviction and a longer time horizon.
All right, so to recap our deep dive today, Q2 delivered solid financial results for this European institution. We saw impressive fee growth, disciplined cost management, all underpinned by a pretty robust capital position. While net interest income, yes, it faced some near-term pressures from currency fluctuations and central bank policies, the company's strategic pivot towards that fee-intensive model and a retail focus fundamentally positions it for continued profitability and capital efficiency, it seems.
Yeah, this sets the stage for I'd say, cautiously optimistic outlook. As the company navigates the current macro environment while steadfastly pushing towards its long-term return on equity targets. It's a really dynamic situation that I think truly highlights the strategic agility required in today's banking landscape.
Absolutely. And as always, remember, this is not financial advice. We're just exploring ideas here. All investment decisions should be made with careful consideration of your own financial situation, your risk tolerance. And it's always wise to consult with a qualified financial advisor before making any moves. Thank you for joining us for this deep dive into the Q2 earnings call. We look forward to our next conversation, uncovering more crucial insights for you.